What makes up the price of that stock is a combination of two things. It is the beer and it is the foam. And the problem is, unlike that glass, it's in a vessel like this. So it's hard to see exactly how much beer there is as opposed to how much foam there is.
History is full of people looking for the one big thing. Of all the companies founded, most of them don't see out the first decade. Hi, I'm Chris Beauchamp, Chief Market Analyst at IG, and today we're looking at financial podcasts and looking at some of the topics they discuss and how you can make them relevant for you as an investor. Let's take a look at the first one.
You have an analogy you came up with that involves beer and a glass.
Beer, right?
Okay.
So I'm pouring it right down the middle so we get a nice thick head.
What are you talking about?
Right now we have a glass and we can see exactly how much foam there is and how much
froth.
Beer
Oh, froth in markets. Okay,
but
we're doing obvious
this
analysis today.
That I poured it into this vessel instead where we couldn't see that. The analogy is the stock market. So when most people think of the stock market, it's all this churning and trading, what stocks are hot now, what stocks are rising, what stocks are falling.
Talking about how,
it's all this
the latest
trading.
hot stuff.
That's not the simple path to wealth. That's the foam, right? What makes up the price of that stock is a combination of two things. It is the beer.
I don't know who this chap is, but it's talking about
foam.
obviously the importance of
and the problem
looking past
is,
the
unlike
noise,
that glass,
if you like.
It's in a vessel like this. So it's hard to see exactly how much beer there is.
The miking up is really irritating in this.
And the beer is the value, the foam is the speculation.
Exactly. The beer is the fundamental operating value of the company, right?
Which is true, but of course, how do you value that?
And the money that's left over that you call profits, right?
Yeah.
So that's the beer. The foam is what the market determines that's worth at any given moment based on emotion.
And
hype and speculation and
okay,
fear
so it's a
and
bit like
greed.
Buffett's about in the short term, it's the voting machine. The long term, it's the weighing machine.
Right, exactly. The total value of the stock. But this is all foam that can come and go very quickly.
I guess Warren Buffett's greatness was he was able to pay for stocks where it was mainly beer, and he paid at the price of the beer, not for the foam.
Or he looked for times where the
there was no foam.
Was so negative that he was actually paying a little less than the price of the beer. It's going to be very, very hard in this day and age to find companies where you can actually buy it for less than the actual beer value.
So value investing is really hard because
do that.
It's
Just
so much easier to do than it used to be in one
companies
sense.
that you can pay a fair price for that have a lot of beer in the mix, that are mostly beer. Because if you buy those companies, they are, by definition, very well-run companies, strong brands, big moats around them, which makes them hard to compete with.
It's really tempting in investing to look for the next small cap stock, tiny stock that becomes huge. You look back and think, well, what Amazon was once a small cap stock, Nvidia was once small cap, and look how well they've done. It's understandable. It's that small cap stocks are interesting and exciting. They've got a story. They have huge movements in the price. But as was mentioned in the video, most investors shouldn't go chasing after small caps because with the potential for big gains comes the risk of big losses. Whereas if you're looking for big companies, fascinating global companies, things like indeed Amazon and Apple. In the UK, we're looking at BP, looking at Rio Tinto, the mine, or even supermarkets. They're not going to see huge stock price appreciation over the next 10 years, but they will see steady, decent returns and will be much less volatile than a portfolio of, as I like to say, crazy small cap stocks, where you get huge risks that most of them, if not all, could just go bust. And that's the sort of history of companies in the US and in the UK. Of all the companies founded, most of them don't see out the first decade. And it's so true in the stock market. History is full of people looking for the one big thing that's going to make them really, really rich. And some people do it by sheer luck. But with investing, it's about conserving your capital. And if you're trying to do that as well as grow it at a reasonable rate, we're not trying to talk about 15, 20% a year. We're looking at 7, 8, 9, 10% a year. Then you're looking at those bigger companies, the established ones. He talks about in the video with the moat is a phrase that Buffett used a lot, that defensive moat that protects them from competition, or at least gives them a degree of protection from competition. They are companies with secure, predictable earnings, ideally paying you a dividend. And for most investors, that's the way to go. And indeed, the vast majority of investors should really just be happy with an index fund rather than trying to go picking individual stocks. Let's look at the next one.
When you're looking at the roaring 2020s,
downtown Josh Brown.
And you just finished reading Ross Sorkin's unbelievable 1929, I found it impossible not to compare the patterns of what was happening then to now.
Sorkin's new book about 1929.
It's unbelievable how easy it is for us as people, as humans,
to
for
sure.
Like, this looks like that.
No, of course. The whole time I'm seeing, this phrase democratization of finance being used.
Is it 1929 all over again?
In the 1920s.
That's amazing.
And then, of course, it's used religiously today as we're introducing all these sort of new, interesting and maybe esoteric products and things like that, crypto and da-da-da-da. Tariffs all of a sudden happen.
Right.
Right. So we're looking at,
my goodness.
I see this happened before, therefore it must be the same again.
Now,
and of course, this time is different. It's that most dangerous phrase in finance.
The movie, we'll see how it ends, but it's not exactly the same.
Josh Brown and Andrew Ross Sorkin talking about the latter's new book. And again, when you've had a market that's gone up so much, like US stocks particularly have over the last 3 years since 2022, and even indeed since COVID and before then, since 2008, there's a temptation really to look into history, an understandable temptation, and try and look at previous periods of what you might call, as Greenspan once said, irrational exuberance, when people really love stocks. And of course, 1929 is still nearly a century after the banner moment when US markets had this huge rise into 1929 and then had a crash. In fact, two crashes, 1929 and 1931, and then the Great Depression. And humans, because we want to see patterns, even in times when there aren't patterns, we say, oh, well, this is like 1929 because, and they're right that there are certain phrases that we use that are being used now and they're new products. Famously, one economist declared in 1928 stocks have reached what looks like a permanently high plateau, for which has gone down in history and isn't remembered for anything else. And the risk is that it's that kind of exuberance. And as ever, it's important not to buy the hype in markets. Things don't go up forever. Market crashes do happen. In fact, more regularly than you would think from what mathematics would suggest. But at the moment, this rally continues to be driven by strong fundamentals, by a strong US economy and earnings that continue to rise. And ultimately, despite what you hear in a lot of financial media and certainly on financial social media, it's not about short covering or stock buybacks. Earnings are what drive stock prices higher. Let's take a look at the next one.
Now, I wonder in that
IG's very own Rich McDonald.
Is there any way to tell the difference between smart conviction?
I've got to be rude about him now, haven't I?
It's a great question. I think you can see conviction and stubbornness. I think lesson for poker, look at the hand, not at the mouth. So I think a lot of the guys I met with experienced smart people.
It's hard to tell investing is between
great. And then you look at the hand
and just being stubborn.
I think that tells you everything about whether
there's a fine line between genius and madness. Sometimes Rich strays either side of that line.
Put the money where the mouth is. That's the approach I used to take. And if they weren't prepared to do that, then it's a kind of, I think your point is hubris, it's lack of admitting they're wrong. No one likes admitting they're wrong. They don't want to say they're wrong. Learning that from a couple of guys.
No one likes admitting they're wrong.
Older, more experienced than me, and they're in positions.
But it's key in investing.
Refusing to sell or do anything when it's down 70%, and you go, you need to make 300% to get back to where you were. But you have to learn that, and are you prepared to do anything? Then it's a real acid test.
An ego can kill off many a performance.
Oh yeah.
So finally, we have wise words from the sage of Edinburgh himself. It's talking about learning to know when you're wrong in investing. And it's very, very hard because we can always see with the benefit of hindsight when you should have bought and sold. But at the time, it's much more difficult. But that's why you have to say, look, I'm prepared to cut my losses in this because I was wrong. And that is a hard skill for anybody to have. It applies in investing just as much as in trading. In trading, we talk about stop loss. In investing, you should also have a point at which you should say, actually, this investment idea isn't working out. It's not doing as well. Because, of course, it's the opportunity cost. Because if you've got money tied up in an investment, whether it's a stock or an index, it's just not doing as well, you have to reevaluate it. Not all the time would it be necessary to sell and to cut the position entirely. You might reduce it to leave it, some of it to run because it might come back a bit. But often it is the risk that you just stick with something that gets worse and worse and underperforms. And it's tying up your capital when you could be putting it in things that are doing better. So you should reevaluate all your ideas, whether they do well or whether they do badly. Actually, you should regularly look at them and say, is this still working the way I want it to? And yes, sometimes you do just have to cut something if it isn't working. And let's take a look at the last one.
Any advice for young investors who are thinking about their portfolios this year? What would your advice be to young people today?
To young people today, it would be very simple. Max out your 401k. Max out
more
your
retirement
IRA
advice.
Invest that money in a very reasonable basket of assets. If you're not yet 30, that's probably 70-30. If you're 30, it's probably 60-40. And by that, I mean S&P versus bonds. Don't trade it.
Stocks versus bonds.
For a long term, don't trade it. Don't think you're smarter than the market, because there are a number of biases that convince people that they should be trading their retirement money, their investment money all the time. Don't. Leave it. Max out.
Inactivity is really hard. It's the key thing for most investors.
You'll be amazed the amount of money you'll have in 10 years.
In investing, doing nothing is often the hardest thing. It's so easy, especially in an era of live pricing, 24-hour markets, ready access to an investment app, whether that's a trading app, whether it's an investment app, or just looking at the stock prices on the FT or even on a Yahoo Finance or whatever you're using. It's so easy to be constantly thinking about, should I be selling this? Should I be buying this? What have I done? I haven't done anything with my investment for a long time. And that's the point in the video. You're looking at the long term. Let things do their work. Let it work in your favor. So many people try and beat the market by doing something different. Doing it consistently over the long term is, apart from a very few people, impossible. There are plenty of examples in history of people who have beaten the market consistently year over year, but they are the select few. Most people are better off doing the boring thing. And this is the problem, I think. It's not exciting, it's not headline grabbing, but it is the sensible thing. And as a retail investor, you've got such a massive advantage over a fund manager. Every quarter, a fund manager has to look at their benchmark and say, did I do better than the benchmark? Did I do worse? And that causes them to overtrade because they're competing against something. You don't have to do that as a retail investor. The S&P went up 5% this year and I went up 4%. It doesn't matter. You don't have to report to anybody or I did better than the market. Well, whoop-de-doo, but it doesn't make a difference. It's about looking at the long term. You don't have anybody to report to every quarter. You don't have everybody to report to every year. You can just let it work in your favor and let time do the investing work for you. And that's such a massive advantage that retail investors really don't understand or don't often appreciate that they have over fund managers. And again, in an era of low cost investing in ETFs, that is the way to go. Thanks for joining me for this episode. Don't forget to like and subscribe and tune in for the next one.